Welcome to NM's Arena. In this video, we are going to discuss the components of money market. The components of money market includes call money market, collateral loan market, acceptance market, and bill market. The call money market is a market for a very short period. The bill brokers and dealers in the stock exchange, they usually borrow money at call from the commercial banks. And these loans are given for a very short period, for a period not exceeding 7 days under any circumstances. But more often, these loans are given for 1 day or 24 hours. There is no demand of any collateral securities against these call money loans. They possess high liquidity. The borrowers are required to pay the loan as and when they are asked for. That is, at very short notice, they will be asked to repay the loan and they have to make the payment. It is due to this reason that these loans are called call money because they can be called back at any time, or it is also called call loans. So this is an important part of the money market, and the interest rate is very low in the case of the call loans, and it changes several times during the course of the day. And the call loans are very much useful to the commercial banks because these can be converted into cash at any time. They are almost like cash. It is a form of secondary cash reserves for the commercial banks from which they earn some income too. The collateral loan market is a market that deals with collateral loans or the loans backed by collateral securities. And these are the loans provided by the commercial banks to private parties in the market. And the collateral loans are backed by the securities, stocks, and bonds. And it may also be in the form of government bonds, which are easily marketable and do not fluctuate much in prices. And this collateral security is returned to the borrower when the loan is repaid. Once the borrower is unable to repay the loan, the collateral security becomes the property of the lender. And these loans are given for a few months. The borrowers are generally the dealers in stocks and shares, but even smaller commercial banks can borrow collateral loans from bigger banks. The bill market is a market in which short-term bills are bought and sold. The important times of such short-term bills are bills of exchange and treasury bills. Now we have to understand what is a bill of exchange. It is actually a written unconditional order which is signed by the drawer requiring the drawee to pay on demand or at a fixed time in future a definite sum of money. Once the buyer signs this acceptance on the bill, it becomes a legal document. Such bills are discounted or rediscounted by the commercial banks to lend credit to the bill holders or to borrow from the central bank. And the treasury bills are the promissory notes of the government to pay a specified sum after a specified period. These are sold by the central bank on behalf of the government. An important aspect of a treasury bill is that there is no fixing of rate of interest beforehand. The treasury offers the bills on the basis of competitive bidding. So one who is satisfied with the minimum interest would be allotted the bills. Since the treasury bills are the government papers, they inspire the public confidence. As no risk is involved in their purchase, they become good papers for the commercial banks to invest their short-term funds. And since discounting is the main process of exchange, it is called a discount market also. And there is another market called the acceptance market. And actually, this is a market that deals with the bankers' acceptances, which is a draft drawn by a business firm upon a bank and accepted by the banker. These acceptance emerge out of commercial transactions both within the country and abroad. It is similar to check, but a check is payable on demand. But in the case of acceptance, it is payable at a specified future date. The banker's acceptance can be easily discounted in the money market because they carry the signature of the bankers. In the case of acceptance houses, no bank funds are involved. The bank has merely added its guarantee to the draft. But the bankers' acceptance are used primarily in international trade. Actually, in the London money market, these are specialized firms, or there are special firms known as accepting houses, which accept bills drawn on them by traders instead of drawing on the true debtors. But in Indian money market, this acceptance market has no significance because there is no development of the acceptance market. There are no specialized firms which render acceptance services in India. Rather, these services provided by the commercial banks, that is also on a very small scale. So that's all about the components of a money market. Thank you for watching this video. For more videos, subscribe the channel.